Hey guys, I'm Rob Tatro. Today we're looking at stock splits and reverse splits. What do they mean for you and your portfolio? That right here, right now. I'm Rob Tatro from robtatro.com, portfolio manager here at Canaccord Genuity Wealth Management and at the Tatro Wealth Advisory Group. This is going to be a fun one today, guys. We're talking about stock splits and reverse splits, what it means for you. When do companies do it? How does it impact the market cap? What does it do to the flows of shares out there on the market? These are all questions that are asked, and a lot of people want to understand this. So we're going to get into it in this video right now. Before we do, take a sec to like and subscribe. Please make sure you share and give us your comments below. If you'd like to book a no obligation consultation to chat about this or anything else, please don't hesitate to go to www.speaktorob.com. We'd love to book a chat with you. So a stock split, how does it work? So first of all, a stock split is when a company's board of directors issues more shares of its stock to its current shareholder, okay? And it does that without diluting the value of their stakes. The market cap effectively stays the same. A stock split will therefore increase the number of shares outstanding and will lower the individual value of each share. Now, it doesn't automatically lower the value of the shares. What's happened is the market will react that way and will price the shares lower the moment they start trading after the split. Think of it this way. You got 1 million shares and you split the shares. That means you now have 2 million shares, right? Same value of the company, 2 million shares. Your shares are now worth half as less because you have double the shares you had before. Now, the companies that do this, why do you think they'd want to do this? So, I mean, there's a lot of reasons why they would do it, but typically it's done because you want to meet a specific goal. So ideally for companies doing a stock split, they're doing it because they want to add liquidity to their portfolio. They want to make the price more attractive and more attainable to a larger number of people. Also, sometimes they do it as a humble brag. Hey, listen, our stock's $700. We did a 7-for-1 split. We still have $100 stock and you now have 7 times more shares. Banks will consistently do stock splits, usually around the $100, $120, $130 mark. Canadian bank stocks have been doing that forever. Some companies have chosen never to do that. Berkshire Hathaway, for example, has a class of shares that they've never split. Hundreds of thousands of dollars worth of shares for one company. Now, there's also companies that do a reverse stock split. So what is a reverse stock split? It will reduce the number of shares outstanding. So if you own 10 shares of a stock for the same company and they do a 2-for-1 split, you now own 5 shares. If you had 10 shares and they do a 10-for-1 reverse split, you now have 1 share. So the total value of what you own will remain consistent. If I had $1,000 or $10,000 of a specific stock, I still own the same amount, right? It's like that old joke about the pizza. Do you want your pizza cut in 6 slices or 8 slices? And the kid goes, 6 slices. I can't eat 8 slices, right? It's the same thing with your stocks. If you have 12 shares or 6 shares pre-split or post-split, your market cap is going to be the same. Now that's the moment the company splits. But in reality, what we've seen happen, this is completely anecdotal. And again, don't take this as investment advice. I don't know your personal situation. I don't know you personally. I've never met you. But historically, what we've seen is a company doing a stock split, in other words, adding more shares, will create more liquidity, typically more buying. Lower prices means more buzz around the company. Also, what we're seeing is typically it hits the news, it's in the media, maybe it's on YouTube. So as a result of that, you're seeing more demand for the stock. The stock typically goes up. Historically, stock splits are seen favorably. And the reversed would also be the same. So if you see a reverse stock split, they're not seen favorably. So a company going from 10 cents to $1, my dad used to always say, if you're doing a reverse stock split because your shares are penny stocks and they're trying to get respect and credibility in the market by doing reverse stock splits, he'd always say, it won't take long before your price is back to where it was before, right? You do a 10-for-1 split for a penny stock, the stock goes to 10 cents. It won't take long before it goes back to a penny. So that's my dad's theory. He's not here to defend himself, so I shouldn't quote him. But we've seen that a lot of times, especially in the illiquid stocks, the penny stocks, and basically a lot of the mining and junior small cap stocks that have a hard time struggling. Again, how does a stock affect you? It doesn't affect you. It doesn't change your value of your underlying investment. Now, you may notice significant difference in the value of your shares. And if you're trading on an exchange that for whatever reason does have current pricing, there might be a day or 2 or 3 where your shares are out of whack. and you think you have maybe double the value that you had before, maybe you had half the value that you had before. That's common, but expect to see that kind of resolve itself in a few days. And again, for those that aren't shareholders, the stock split may provide motivation to buy. So I talked about it earlier. You couldn't afford it before, now you can afford it. You've seen it in the news, maybe now you're buying in. So the added liquidity, the buzz, will often create positive momentum around stock splits. All right, the bottom line with the stock split, a 2-for-1 stock split, typically you will own double the shares. Each share will be worth roughly half on trading, and typically there's positive momentum that happens after the stock starts trading at the new price. A reverse stock split, you end up getting less shares, so half the shares. Typically, the shares will go up in price, roughly the equivalent, double, but they typically trade down as it is negative momentum after a reverse stock split. Companies that are doing reverse stock splits typically are trying to meet a threshold or a number or a liquidity or a value of a company to be listed on a specific exchange. And we saw this with Peak FinTech, one of the videos I talked about in the past. I interviewed Johnson Joseph, and he talked about how they did a reverse split to get their shares high enough to be on the NASDAQ. And after that happened, boom, the stock took off. So remember, if you're seeing a stock split, what it can do for your portfolio, if you're not sure, don't hesitate to reach out. Go to www.speaktorob.com. We'd love to book a no obligation consultation to chat about this or anything else that's on your mind with respect to investments. I'm Rob Tatro from robtatro.com, portfolio manager here at Canaccord Genuity Wealth Management and the Tatro Wealth Advisory Group. Thank you for tuning in. See you in the next video.